first. Let's start the recording. Let's kick things off. Hopefully you can all see my screen. Look, everybody, welcome to Club Live. Again, I hope everybody that's attending has had a great week as well. Do drop a little hi in the comments so we know everything is working as it should. As always, if you've got any questions for Ben throughout today's webinar, do let us know in the comments and we will answer them as we go along. When you exit today's webinar, there will be a feedback form that pops up. So please do leave us your thoughts. There's also a section within the feedback form where you can request a CPD certificate. So if you do require a CPD certificate from today's webinar, do let us know in the feedback form and we'll get that over to you as soon as we can. Just to give you a bit of an introduction behind the club, who we are. The club is Amanda, Lewis, myself, and Jade, with the huge backing and the support of every single one of these incredible firms. Great content delivered by our awesome collaborators. This seems to be growing week in, week out at the moment. We're doing a lot of good work with a lot of good people that are just bringing so much innovation to our profession. It really, really is very nice to see. As many of you may know and may have come from one of our communities, we are building a community that works for everybody. People need to talk. People also need support. So we've got individual WhatsApp communities depending on the role that you play within your business. So whether you're an owner, whether you're an advisor, whether you are responsible for the operational aspects of the business, a power planner, whatever it may be, we do have individual WhatsApp communities for you to be a part of. Our weekly club lives bring you insights from industry experts such as Ben from Albion, who is joining us today. And our podcast is where you can hear stories from those who are running a financial planning business today. Listen to the highs, the lows, and what people go through to build good businesses. Quick shout out to the webinars that we've got coming up over the course of the next few weeks. On Wednesday next week, I know we're pulling away from the typical Friday at 10 a.m., but Wednesday next week, we are with Timeline. We are focusing on building and really building a streamlined modern advice practice and engaging the next generation of clients. Always a very interesting topic when it comes to engaging the next generation of clients, which is good. On the 6th of March, so back to a Friday, we're exploring how stronger case reviews, reduce PI risk and strengthen your advice process with Bear Rock. And on the 12th of March, we are with FE Fund Info, and we're really looking at how data improves decisions, reduces risks, and saves time. As always, all of our club lives, all of our webinars are CPD accredited. We try to make things really relaxed and conversational. So please do come along and ask any questions and speak to the experts directly. Really pleased to be here with Ben Edwards today, Director at Albion Strategic Consulting. Ben joined Albion in 2015 as an advocate, really, of evidence-based investing, helping firms build robust, research-driven processes that improve the client outcome. So, Ben, welcome, and thank you for joining us today.
Thanks, Lee.
Not a problem. So, as everybody knows, when you registered for today's webinar, we like to ask a couple of questions. We like to relay that back to the audience. We've got a good mix of IFAs, planners and power planners, mostly coming from independent firms. A lot of attendees, their clients are already in drawdown. So retirement income planning is very much live as we speak, which is great. The main aim of today is to really strengthen the income processes, particularly around withdrawal strategies and communicating sequencing risk. So Ben, the floor is yours. Over to you, and look forward to today's session, mate.
Awesome. Thank you. And thanks everyone for being here as well. Am I able to snatch the screen share here?
Yeah, I'll stop sharing so you can take over.
Thank you. Awesome. So yeah, we're going to be talking about sequence risk today, an important topic and one that we at Albion very passionate about it, that its sort of importance and prevalence, and need for understanding across the industry. We focus on anything at Albion, from portfolio construction, research, documentation, ongoing governance, and also communication of investing topics and wider sort of financial planning topics to clients as well. So I guess one important part of that is things like sequence risk, where we're talking about that important transition and scary transition that any investor can make from moving from accumulating to decumulating. And that transition is a big one for anyone to make. And so understanding as much as possible about that, it's not just a big one emotionally, but it's also an important one financially. And as we'll go through today, trying to get a sense of how important it really is and how we can think about different ways to communicate that to those investors that are going through that big stage in their lives as they transition ultimately into retirement. We will be what we won't be doing is coming up with a one-size-fits-all silver bullet solution, because it probably doesn't really exist unless someone is wealthy enough that they don't need to be invested in something with uncertainty, such as stock markets. Then they're going to have to be subject to an amount of uncertain returns, and by definition that introduces things like sequence risk. We can mitigate it with sensible techniques, and we're going to be exploring some of that today, but we can't make it disappear, unfortunately. So there's no silver bullet, but what we can do is get a scale of the task at hand and put some of the numbers into context as well. So without further ado, just to set the scene, this is what lots of investors will arrive at an advisor's door with this information, an account value, and they're sort of at this point where they're considering, what does this really mean for me? I've spent this time building up my savings, obviously a very, very oversimplified example here, but what do I want to do with it? And that's the point where they meet with an advisor. They help work out what their basic spending is and what other goals they might be. And for a client, for an individual, they're real things, their financial goals, which are life goals, dream holidays, gifts for the kids, whatever it might be, stretching out into the distant future. And so a big key element of that advisor-client relationship is obviously determining what we have today, where we can put that today in order to meet those financial goals in future. So that's in the context of what we're talking about sequence risk today. This is the context. It's in a financial planning context. We're talking about those individuals that are making that big transition from accumulation to decumulation, and understanding that those assets are going to need to fund future spending. And so we're being considerate about what that sequence risk in that context. There are different rules of thumb out there, potentially oversimplifications, simplifications, and I don't necessarily think that anyone really probably uses these without considering other alternatives. But one is the 4% rule. We've got here an axis on the left hand side here, which is the lowest safe withdrawal rate. And so what the 4% rule is saying that we could withdraw 4% over the original analysis performed over 30-year retirement periods, 4% of the initial starting pot, adjust that upwards by inflation, that amount, whatever that is, by inflation every single year for that 30 years, and never run out of money. And so this was done in lots of the original modeling in long-term historical performance in the US, for example. It's been extended now to overseas markets as well. And it does give a sensible starting point, but crucially, it is just a starting point. And there are other insights. This is one taken from some research performed by Professor Wade Pfau in the States, which shows that if you focus on the US, it's about 4%, but actually in other markets, that's been much lower in the past. Now, these are extreme examples. This is the maximum you could have withdrawn at certain times without depleting the pot was an exceptionally low number. But these would have been during times of sort of extreme circumstances, war-torn countries and whatnot. But what it goes to show is that, importantly, it is just a starting point for discussion, and that it will not be a one-size-fits-all, as many of you will know. So starting to get into a point, consider what sequence risk is, and just in a second, Lee's going to raise the first poll of the day. So there's a bit of interaction today. We've got a few polls running. But I think one important caveat is that in the academic literature, and in investor insights and industry practitioner insights, ultimately there are going to be assumptions made with any amount of modeling. And the same is the case for lots of the insights shared today. And I think we can accept that. The fact that there are few, if ever, any clients who will withdraw 4% at outset, adjusted by inflation every year for 30 years until death on the first day of year 31. Obviously, that's an oversimplification. So what it does, and obviously the things like tax consequences, individual client circumstances. So what we're really doing here is trying to build ourselves a sensible starting point, an understanding of the task at hand, as I've referenced to already, and that's the important point that of why we're reviewing all of this research and I guess trying to get a sense of quantum really of the issue at hand. So yeah, Lee, I'll hand over to you to launch the first poll.
Yeah, so let's do that. I mean, in your experience, have you seen advisors become more cautious with starting with the withdrawal rates in recent years? Do you see that fluctuate depending on the markets, I suppose?
I think we've actually probably seen the opposite.
Okay.
And I think that's come from maybe in two parts. I mean, I'm sort of talking probably anecdotally here because I mean, this sort of insight from the polls today are going to give a sense of what those rates are. My sense is most firms will not have sort of a single withdrawal approach, and it'll be totally flexible depending on the client's circumstance. But I think we've definitely seen an increase in risk exposures. We've had 20 years near of really strong markets since the financial crisis. Any crash has been short and sharp. Balanced portfolios have probably increased 50% in purchasing power terms and growth of wealth in the last 10 years. And any falls since then, COVID, 2022, I guess was a tougher year as well. And you could probably label a couple of other years. They've not really been anything as a long protracted drawdown. And that in part has biased investors up dragged investors up the risk spectrum a little bit. But another important point, I think, which is relevant, is that our understanding of markets and what it means to be an investor is continually increasing. And so that understanding that's been baked into every advisor's conversation gives an ability to make an evidence-based decision as to where on the risk spectrum they might be. And we almost face a decision as an investor to say we've got to talk ourselves out of the 100% equity solution. If that's the highest expected return solution, then why would we not want that? Well, there are very good reasons why you might not, and that's because you might need the money sooner. You might not have an ability to withstand such levels of volatility, and so you talk yourself away from that. And guess that understanding, as that builds through time, that might give investors and advisors an ability to talk about increasing risk. But I guess today is trying to sort of raise the flag for the side that it isn't risk-free, and it is sequence risk itself is a risk that is always there, has always been there, but maybe not has presented itself in the past 15 years or so.
Yeah. Interestingly, the results, reflect and mirror what you see, really, that people are not typically using or have a rule of thumb with the initial withdrawal rate as well. So
yeah, and I can see there that there are obviously some in the lower side, so between, I guess, below 4%, and I think that's an opportunity to, being on the prudent side, all of this. I understand every advisor will have a narrative that sits behind all of this, and there's no right answer to any of this at the end of the day. And with the appropriate positioning, any of these can be reasonable. But maybe with that prudent starting point, the flip side of the risk is that an investor might be left with too much or more than expected in the pot at the end, which is almost like foregone experiences potentially. So understanding where that 3% or 4% or 5% lies in the context of the long-term outcomes, it can be quite useful in trying to, again, it's that regular conversation where that becomes important.
Yeah, absolutely. Thank you everyone for getting involved. I'll stop sharing the results now.
Brilliant. Thanks everyone. Okay, so moving into an illustration of sequence risk itself, and as we just alluded to, it's it's not really been something that we've seen reveal itself in the past, say, 20 years, and certainly the last 10 and 15. For those reasons that falls have been short and sharp, and recoveries fairly quick, and growth has been fairly strong across global equity markets. But that doesn't mean that sequence risk hasn't been there. It has been there, and in a sense, as we'll explore a little bit later, there's an argument to say it's going to be present and in an increasing capacity going forward. The reason that there's a lottery machine shown on screen here is that's the illustration we're about to delve into. And what we're going to do is simulate sort of live example simulation of a lottery machine of returns. And we've got returns from the past nearly 100 years, and each of the annual returns we're going to take out of our lottery machine. But different to how it would happen if you're watching it on TV, is we're actually going to put that ball back into the lottery machine and spin them around again and pull out another annual return. And what we're doing there is simulating a series of returns. So we're going to simulate 30 years of returns from returns that have actually happened, albeit not necessarily in exactly the same order. And this is a statistical technique. It's called bootstrapping, and that's what we're going to simulate. And in a sense, to try and illustrate sequence risk itself, which is the risk of a series of poor returns in early retirement or approaching retirement. So I'm going to pull up on the screen a spreadsheet-based tool. Hopefully that's shown on your side as well. This is a spreadsheet-based tool which is we provide to our client firms. So it's a sort of a simple tool to try and illustrate sequence risk. We call it the sequence risk illustrator for obvious reasons. And let's move my Zoom window out of the way there. So we can see over the left-hand side, there are two sides of this spreadsheet. The left-hand side, which is the input, the right-hand side, which is the output. So we're going to focus all of our attention at this point in time to the left-hand side. Now here we have 30 years going from this year going forward down the, as you can see by the dates, of returns that have yet to pass. And what we can do is choose any return from this big drop down list of returns here. Now all of those are those annual returns that have happened historically. As you can see, we've had some really crummy outcomes in any one particular year, minus 24%. These are all in after inflation terms, to positive 26%. These are all for a balanced portfolio, 60% equities, 40% in bonds. If we were to click this 1+1 button here, what this does is use the lottery machine to pick out a random return. And as you can see, when I've just clicked that, we've had a pretty good first year of retirement there. And this is imagining that this investor has got their pot of money and they've just invested it in this balanced portfolio. We can click it again and again and again, and you can see it's generating random returns. Now, those random returns, again, as a reminder, have actually happened historically, but as I said, not necessarily in that order. We can click this button and fill the remaining. As you can see, it's quite an exceptional outcome here of 8.2% over the whole time period. I can add that life onto the chart, and as you see, you sort of end up with left and right tail events. This is probably one sitting in the right tail, and this would have been an absolutely brilliant journey for any investor. You've ended up, after inflation terms, increasing tenfold over that 30-year period. We could add another 10 lives to this chart here, as you can see, and it demonstrates that there's a wide difference in potential outcomes that have happened. Now, all of those are using exactly the same simulation that we did. We could click that 100 times and 1,000 times, and then suddenly you're in a realm where we're sort of simulating a bit like what a Monte Carlo tool is doing at the end of the day, and getting a sense of how successful different plans can be with different assumptions. One thing, an important point at this point in time, is that there are no withdrawals from this portfolio. This is simply, in this case, £1 million with £0 withdrawn. And so we're just looking at a 30-year investing time period. If we now introduce a withdrawal, so 4% of the initial starting part, £40,000, and adjust that 40,000 by inflation every single year, and now we refresh the outcome, you can see we've got our initial simulator that we simulated together. That scenario performed pretty well. There's some that did pretty well in the middle. You ended up with money left at the end, but also there was one here that actually didn't survive the period. So this is the sequence risk in itself presenting itself, and part of that randomness of outcomes presenting itself, that we don't know what future that we're going to live and our investors are going to live. And so having an understanding of necessary flexibility and spending rules that might be required is crucially important. So I'm going to reset all of these inputs and clear the chart. And now to really clearly demonstrate sequence risk itself, instead of using randomly selected returns from the past 99 years, I'm actually going to select a series of returns that did happen in this order. So starting in 1950 through to 1979, we're going to imagine that we go through exactly the same 30-year period again. And that's what's been populated over on the left-hand side here. You can see we had an annual return of 4.2%. I'm going to add that onto the chart. We've got no withdrawals at this point in time. So that looks like a pretty normal investing time period that could well happen. I'm going to do exactly the same for a period starting in 1968. And the reason I've chosen 1968 is not random, as you'll see as I add this to the chart, is because they end up in about the same place. And importantly, the 1968 scenario actually had the worst 15-year starting point out of any other rolling period in the entire sample. So it's quite unique in that sense. But both of them get to about the same point. And in absence of withdrawals, they end up with similar outcome. But let's have a look at what happens if we, in fact, before I do that, what we can do for illustrative purposes, if I had a straight line return of 4.1%, which is about the average return received for both those periods, you can see you end up at about the same place, again, unsurprisingly. So now let's add a withdrawal for this scenario. After I refresh that, it tells a quite compelling story that the 1968 scenario depleted the pot down to zero. The straight line assumption ended up with about the same left as what it started with, which is fairly logical. And the 1950 scenario ended up with even more than it started with, despite having taken that 4% every single year, the £40,000. The reason for this is exactly that point, that the 1968 scenario had a really poor starting period. And so you're taking cash from the portfolio when it's down, almost selling shares when they're at depleted values, and not allowing the time necessary for those share prices to recover in time. And this is sequence risk shown really starkly. We do face choices as investors at this point. We don't have to obviously take 4% and blindly into oblivion over this 30-year period. We could introduce something like guardrails. Now, guardrails enables us to take a little bit more if the portfolio has done well and reward ourselves for that good performance, but at times make the difficult choice to actually take a little bit less if we've not been so fortunate with market returns. So if I refresh that now, we've used a simple example of guardrails here where you just curtail spending by 25% if the portfolio is down by 25% and vice versa. And you see that even the 1968 scenario in this sense in this example, did actually survive the period. So this is not to say that that's the only way and the best way to actually implement a withdrawal strategy, but it demonstrates the benefit and the potential how being cognizant of the fact that actually varying spending and necessarily varying spending can be a really powerful point to consider and discuss with clients upfront, importantly, and at those really difficult times, have that challenging conversation with clients with a view to ensure that plan does survive the period. So hopefully that was a useful illustration of sequence risk and try to put it into context to really what sequence risk is, which, as we said, is the risk of a series of poor returns for those investors that are either nearing retirement or in early retirement. So to try and add a little bit more evidence and to that, understanding the magnitude of the risk of sequence risk and where it really starts to reveal itself. This is a somewhat simplistic simulation, as I said, with all the caveats noted earlier on, with around sequence risk itself, any modeling around retirement income strategies itself. So here we're modeling a 60-year lifespan where the first 30 years we are accumulating, so adding to a pot, and the final 30 years we're decumulating. It's invested in a balanced portfolio, and what we're measuring is each individual year, how important that year was in determining the overall outcome. So over a Monte Carlo simulation, 100,000 simulations, how important was that particular year on average over the entire time period? And as we look at what happened, you can see a peak around that 0 year, the year which we flip from being accumulators to decumulators. Is logical and it makes a lot of sense, and it really starts to ramp up in those years nearing retirement, 5 years out, say, and certainly 5 to 10 years years after that, that's where those pattern of returns are crucially important in terms of determining whether that outcome is likely to be more or less successful. And that's where things like flexibility in spending become really valuable conversations. The reality is we face lots of unknowns. We don't know what the future holds, and this is what the historical markets have held. Previously, we could have a look here at nearly 100 years of market returns, but also some really important, significant world events that have happened in time over that time. Now, markets have been resilient, but there's uncertainty in markets, as you can see from the wiggly line shown on screen. Now, that's an investor's journey, and there are loads of significant events that will have happened through time. The reality is, if we think about an investor's time horizon, it might be 30 years, it might be significantly longer than that. That's probably taken up 30 years. It's nearly a third of this chart. And you look at all the significant events that have happened over that 30-year period, it shouldn't be a great surprise that there will be more significant events happen over the next 30-year period. So almost that uncertainty, it's always there, it abounds, it always does. And being ready and accepting that is an important part of investing at the end of the day. I did ask ChatGPT what was going to happen in the next 30 years, and it provided me with these sorts of examples. So we've got World War III. We have got the end of fossil fuels and carbon neutrality, but we've got other things. We've got AI surpasses human cognition there, global water crisis. So some good, some bad. Reality is we don't know what we face ahead, and we certainly don't know what markets, how markets will react to whatever we do face ahead. So uncertainty, it's there, and what we've got to do is plan, as advisors working with clients, is plan for that unknown future. So Lee, I'll pass over to you to raise the next poll.
Absolutely. I just want to call out that spreadsheet was amazing, by the way.
I can only take partial credits from a very clever analyst.
Yeah, spreadsheet's not my skill set.
Someone wise once said, always employ people smarter than yourself. So we'll stick with that
one. Mate, look, rewind the clock 10 years. Are we answering this question differently?
It would be, I think, the 10 years ago, the financial crisis was fresh in everyone's minds. We had the tech wreck in the early 2000s, which was a 3-year protracted drawdown. We had 10 years between 2000 and the end of 2009, which was the lost decade in the US, where US markets were down. It was, I think, the ability to quickly understand and acknowledge the risk was probably easier at that point in time. But it doesn't mean, I mean, it was still there as it is today. We're fortunate as investors and advisors that we've had a great 10 years since then. And that's great for client expected outcomes. Those that have retired in that time have been through that time where secrets risk is most relevant, and they hopefully now face a good chance of a successful outcome. It's sort of always there. I don't know if the conversation would be different to that extent, because it's not. It's been there then and it is there now. And I mean, when Albion was founded in its early days, we were talking about sequence risk with groups of firms. At the end of the day, it's something that is always and has always been there. As long as an investor requires their money that's invested in the stock market to fund spending, it's there at the end of the day.
Would you say firms and advisors are like, they're better at identifying risk than they are managing risk?
That's a good question. I think I would say that I mean, I'd say everyone has a good opportunity and a reasonable ability to manage those risks. For us, you've got to have process in place to identify those risks at the outset. The identification process is a really important one, and without it, we could very quickly in investing in general, get drawn down a path of taking on risks that we didn't necessarily know we were taking on, or we sort of knew they were there, but we didn't identify them and look to mitigate them. An example might be something like illiquidity. If we're using something like a bricks and mortar property fund as an example, if we didn't want to expose ourselves to the risk of illiquidity, then we shouldn't be in those sorts of structures, as a very specific example, or private equity, whatever it might be. And so that risk identification process is a part of the process that we should go through for building portfolios as businesses as well. Importantly, we should go through as a proper risk matrix, impacts, mitigants, the scale of the risk, our likelihood, the likelihood of the risk itself. That extends to probably every part of life, and the best way to identify what those risks are is to have a process to sort of think about them, and then the choices you face, the four choices with risk, which is you either accept it, you reduce it, you transfer it, or you avoid it entirely. You face those four choices, whatever you do with risk. So it comes back to process all the time. So yeah, I'd say everyone is probably we can identify risk. We're human beings. We are wired to almost try to understand the risk of a situation. I mean, you go back millennia, that would have been potentially hearing a lion rustling in a bush. That was like trying to identify what we should run away because it might actually be a lion in the bush. So we're always trying to sort of think about what could happen. We're sort of forecasters by nature, and so that almost makes us sort of trying to understand and mitigate risk as just in our human nature.
Yeah, absolutely. Sorry for any curveballs thrown there and got you thinking on your feet.
No, I like that. Love it.
Again, thanks everybody getting involved in the bowl.
Cool. What we see there. So yeah, biggest risk client outcome, early market drawdown, inflation, longevity, poor behavior, a real good spread between all of those. Fees, yeah, not included. I think I'd almost see that there's an opportunity for probably all of those to have a representation there. I when pulling this question together, I couldn't work out which I felt was where I felt more strongly about. I probably came down on inflation in the context of sequence risk, just understanding that some of the research will support the notion that the inflation regime that one lives through is far more determinant or is more determinant in outcomes than any other element. But the reality is that all of those are really important. If we go through a period of really, really high inflation, we can identify the 70s as one of those periods. It can be really tough to keep pace with spending increases if market returns aren't kind enough. So, but yeah, as identified there, plenty of other really important issues.
Absolutely.
Okay, so an important part of financial planning, cash flow modeling, and it extends to those in drawdown as well, is formulating sensible central case assumptions. So asset class assumptions, portfolio assumptions, assumptions obviously around things like expected inflation and other elements of the cash flow modeling process, wage inflation, savings rates, all those sorts of things. They're all assumptions and central case assumptions. Obviously, tax being another assumption that might be baked in. We know that there's a huge amount of uncertainty with all of those, certainly including things like tax legislation, and knowing that will probably be different in 10, 20, 30 years' time. The same is certainly the case for market returns, and all we can really do is develop a central case assumption, which gives us a defendable starting point for discussions. This slide, I haven't shown the table yet because it's a rather ugly slide, and what will be shared, these slides will be shared with all attendees after this, I believe. So this will be almost like a reference point. What the table that's going to show is an example of assumptions that we pull together for the firms that we work with. We write asset class assumptions papers every couple of years. And in doing so, we gather industry peer assumptions as well, just to sort of evaluate our own central case assumptions in the context of theirs. We form assumptions through our own methodology. There's plenty of other methodologies out there, and ultimately it's coming down on a place that you feel provides a sensible starting point for discussion. And as you can see here, there's a range of assumptions from a range of different academics and practitioners, which will vary by time horizon, magnitude, currency, methodology. And so all we're trying to do here is build a sensible starting point. The point is not getting this precisely right. And by the time we're talking about decimal points, we're in the realm of spurious accuracy. But the point is really to get something that makes sense and then to model beyond that. That's what's crucial, more crucial than the actual level of returns itself. So that's an example in the case here for developed market equity. real returns, so above inflation, expected returns, our assumptions that we make are over 20 to 30 year horizons. So 3 considerations, takeaways for building capital market assumptions. As we've just said, this is center of a very wide distribution. We struggle to really know precisely what backward-looking returns are. From a statistical perspective, to be sure what things like the equity risk premium really are, let alone what they are going forward. So accepting that there's a really wide distribution of outcomes, and this is a central case starting point, is crucial. Modeling volatility using things like Monte Carlo tools as an example to say that, as we've identified and illustrated today, that returns don't come in straight lines. Deterministic returns, so a straight line return assumption, as we saw in the example earlier, is a blunt tool for used in isolation for cash flow, for the cash flow modeling approach. It requires that need to model alternative scenarios, haircuts, one-off cash out items, crash scenarios, things like that, to really test the sensitivity of a financial plan, ultimately planning for that volatility, which we know will come to pass. And finally, making sure the assumptions are reviewed on a periodic basis, whatever that might be, annually, biannually, every 3 years. The regulator certainly wants to make sure that those assumptions are reasonable, they're defendable, and there's a process that sits behind, an ongoing process that sits behind making sure that they are make sense in the cash flow modeling approach. So the third and final poll, Lee, I'll let you throw up here.
Absolutely. There we go. What changes first? Is it the plan or the client's behavior? Do you tend to find?
I would say they sort of both work concurrently, because if we're, I mean, an investor, I mean, there's a wide range of different investors. An investor meets with an advisor. Often, what they're thinking about is something that might be, I just want to sort my pension, for example. But actually, the full financial planning is far wider than that, far broader than that, and a more holistic approach. And in a sense, part of that journey is education with the client and helping them understand what is reasonable to expect, there's going to be volatility, that sequence risk exists, and if there are really crummy returns, because maybe they're not wealthy enough to just simply buy an annuity, for example, and live out their days doing everything they ever want to do, they might have to take on market risk. And so there's no guarantees here. And look, if returns are really poor, we're going to have to make haircuts here and there, whatever that might be, turning right on the plane rather than left on the plane, things like that. Is those sensible conversations. Now, that is part of that educational journey, and also feeds into the financial plan as well, because those modeling scenarios are part of, sort of coincide with those conversations to say, this is what might happen, so let's model accordingly. And often what can be the case is that an advisor sitting there to reassure the client, to say, even in those really challenging scenarios, as you can see, this is what you can achieve. You can meet all your subsistence spending, and you can maybe achieve these more aspirational goals as well. And so those they're sort of, I'd say, they coincide with one another.
So the idea of the old set and forget, that's just something that we don't even consider, really.
Yeah, I think that's a huge value in a role a financial advisor plays, that it is absolutely not set and forget. And I think that's hopefully clearly illustrated with things like, we can't meet today and say, very few cases where you can say you'll be fine whatever happens. And the reality is that most will need advice, and that is certainly through changes in things like tax legislation, changes in life circumstances, but also changes in markets as well, which is an important part of that. There are many reasons why an advisor adds value to a client on an ongoing basis.
Yeah, absolutely. Results are in. And what's nice is that every time we've run a poll, we've had more people participate as the webinar goes on. So that's always good to see.
Good work, everyone.
Gonna share the results. Would you echo what you're seeing here in the results?
Yeah, I think so. I think that point, the larger focus around that it is in part, that cash flow modeling approach is sort of determining what those spending levels are. I mean, in a sense, for a client, it means nothing to say that you can spend 4% of your portfolio every year. What it means is, as that very first slide we started with, what it
Yeah.
means to them is that can they meet their basic spending, and can they also achieve their other financial goals? Reality is that there are some rules of thumb that we can use, as we identified. The 4% is a great rule of thumb to potentially use to start discussions. And there's some examples there of using sort of implementing fixed amounts with inflation. Part of this, again, is all around every advisor. Certainly one thing we know from working with advisors for over 2 decades now is that we know that every firm works differently, has different client bases, have different educational journeys they take clients on. And so there's not really one way to do all this. Otherwise, if there was, we wouldn't really be discussing this. So there's plenty of ways to have a great conversation, evidence conversation, and improve, provide a valuable service to a client.
Yeah, absolutely. Everyone, thanks for participating in the 3 polls. I'll stop sharing and back over to you, Ben.
Thank you. So the final sort of section here, we're I guess just raising this point at this stage to say, is it going anywhere? And Lee, you've already sort of alluded to this question historically, and I made reference to this, that the fact that it may even be increasing in its prevalence in terms of the risk itself being there, sequence risk. And that is because we see here, these are DB, private DB schemes in private companies in the UK. You can see the number of those that are open has been decreasing, and plenty of those winding up, close to future accruals, close to new members, which are what all of those acronyms mean at the bottom there. The point here is that there's not an increase in number of DB schemes. Now, you may well have many clients that already have defined benefit income, which is great, and it's a really valuable, can be a really valuable part of retirement income planning. But that's not looking likely to increase, certainly in the private sector at this point in time, and probably in the public sector as well to an extent. So what does this mean? Well, it means that investors might have or will have savings outside of their DB pension, or it might mean that they maybe haven't made those enough savings outside of the DB pension. So in both of those scenarios, sequence risk becomes more relevant, because they will be more reliant on invested assets, or their required income needs are a higher proportion of what their total assets are. And so the conversation around sequence risk becomes ever increasingly more relevant. And so being ready for this as advisors, I think, is a real opportunity for the financial planning profession in the next sort of the decades to come, to be ready to have really sensible conversations and help clients navigate this journey of an unknown future. An important part, and this was actually one of the points that was raised earlier in one of the polls, where many felt that longevity risk was an important consideration in client outcomes, and it absolutely is. And this is what we're trying to demonstrate here, that we've got failure rates on the left-hand side. So over a Monte Carlo, we use bootstrapping, sorry. So exactly the same simulation that we went through a single bootstrap with in our spreadsheet earlier, the very first thing that we did. We're doing that here, modeled, but 1,000 times over. And so we're trying to give ourselves more of a sort of statistical insight into many different many different investing time periods. So the failure rate on the left hand side tells us how many times the financial plan over the 30-year time period went to zero. So 100% of the time would mean that it never actually survived, and 0% would mean it survived in every single circumstance. The withdrawal rate is as we've done consistently so far, is the amount that you take from the pot to start with and adjust that by inflation every year. So 4% would be £40,000 on a £1 million portfolio, and so on and so forth. So if you had a 20-year horizon, you can see that naturally, as you withdraw more from the portfolio, your failure rate increases. And if we look at something like the 6% withdrawal rate there over 20 years, that in 10% of cases it failed. Flip side of that is 90% of cases it actually succeeded. So that's you might look at that and say, well, that gives an opportunity to have a real in-depth conversation about the risk that it entails. There's no guarantees, of course, but the odds are stacked in your favor based on this bootstrap simulation here. If we increase our time horizon to 40 years, over that within that 6% withdrawal rate, you can see now it's a coin toss as to whether the plan survive the 40-year period. So by doubling that time horizon, it demonstrates longevity risk inherent in I guess in this sort of withdrawal scenario here. So just an illustration, but hopefully one to highlight the point around that. Yeah, certainly longevity is a concern, an important concern. As lifespan, health spans are increasing, retirement age of client basis might decrease. These are important concerns, and obviously with intergenerational planning as well. One point I wanted to raise was around bucketing. It's often touted as, or sometimes touted as a solution to sequence risk. The prospect of having different buckets of assets for an individual client where they will invest different things in those different buckets. So you might have longer term bucket, which will be more heavily invested in stocks, and your short term bucket might be cash or bonds. The reality is that you own a balanced portfolio at the end of the day. You blend the bonds and equities together and you end up with an asset allocation, and there's no secret sauce in the bucketing approach. It doesn't make sequence risk disappear in this, and your outcomes are there or thereabouts the same as if you simply had a balanced portfolio and withdrew from the portfolio itself. Now, if you had a situation whereby, say, markets were down, and so you don't want to sell your stocks, you take from your cash, it's exactly the same situation as if markets were down in your balanced portfolio and you sold your bonds to rebalance, but instead of rebalancing, you took the income, which is what you need. Mathematically, it's exactly the same. That's not to say that it's not useful, and I think there's a real compelling case for a real simplistic story for clients. And if a client can understand the bucketing, something like a bucketing approach easily, this is an example of a bucketing approach, a simplistic example of that. And if they can understand that and they can stick with it, that's really crucial. And it's maybe far easier to explain than what a balanced portfolio is, for example. So we certainly have some sympathy for the argument itself, but I guess our point just wanted to raise, it's not a silver bullet. It is mental accounting, but it can be a really powerful narrative as part of the educational process with clients. So this final slide, and I'm going to talk through this one. And what we're going to do is move ourselves from the bottom of this pyramid to the top. And it's just really a bit of food for thought. And it's sort of inspired by some work by Wade Fowler, who we actually referenced some of his research on the second slide today. Wade Fowler and his team in the States, they are say prominent retirement income researchers. They release all sorts of seminal insights, and they focus on this concept of a retirement income style. And they have a retirement income style awareness tool. And that is in a similar way that we talk about risk profiling with clients. This is a psychometric association of how an investor wants to receive their income in retirement. And the reality is that everyone's different, and there are preferences around that and how investors want to receive it. There's some individuals want security and they want safety and they want guaranteed income sources. But the risk and the challenge with that is that might come with lacking flexibility. It might come with low or no chance of capital growth. And so it's they are real trade-offs that they don't have a right answer. It's a preference-based decision. So navigating up this pyramid we start on the right-hand side here, which is where the arrows begin. And on that right-hand side, we have income certainty. So we think about, if you're probably already thinking about what assets that might be cash. It might be things like directly held bonds, annuities. It might be bond ladders as well. As an example, DB pensions, they have income certainty, but what they don't carry is a chance of capital growth, or at least a very low one at that. So we start on the right-hand side, and we might have, as an investor, enough of an income certain asset base to be able to fund our basic level of spending, which is shown in that first tier, the red tier there shown on screen. But at any time in this journey of moving up the pyramid, we have the choice to move to the left-hand side of the pyramid. Now, the left-hand side of the pyramid is where our income uncertain assets are, and that will be your invested portfolio in a sensible invested portfolio where things like sequence risk start to introduce. But the only reason we would want to move there is because we've got the higher chance of capital growth. So we, at any point, can move to the left-hand side of the pyramid. And as we go up, we might make that decision at each one of these parts of the pyramid here. So the first level, maybe most, that they might prefer that is actually kept in the income certain side of the pyramid on the right-hand side. Perhaps as we go to the second tier there, there's an opportunity for those investors to maybe move to the left-hand side to meet some of those important spending goals that sit further out, even if they're a little bit more ambitious. But part of all of this conversation is going to be down to an individual's own preference, their own style preference for how they want to achieve income. At the end of the day, some individuals, they enjoy the risk-taking process. It's their spice of life, and it's sort of having some acceptance of that. And as we get to the icing on the cake, spending at the top there, some might be wealthy enough and have a desire to simply own a bond ladder and own those income certain assets, and being able to stay on the right hand side of the pyramid for that whole time. For most, is the reality they might want to and have to move to the left. Certainly if they're going to say turn left on the plane, buying the Ferrari, whatever it might be. And these are the choices that we face. And so it's introducing this concept of income preference and style, which is, as I say, sort of where some of the research is going from the leaders in the space in the States. So just to sum up, as I said there, we've got sort of 5 takeaways here. The first one, as we've just been through, which is considering an individual's appetite for securing income versus pursuing capital growth. And yet, for those that are interested, I'd urge you to look into the retirement income style awareness tool from Wade Fowler and his colleagues in the States. It is American focused, American centric, but there's certainly some interesting insights that even at this case, it's just sort of taking them forward into client discussions of being aware of them as clients are considering what they're as they transition from accumulation to decumulation. Where assets are invested, this is something we're highly passionate about, that should be in an evidence-based solution. For us, the evidence points heavily towards a risk factor tilted systematic solution. If 50 basis points are foregone in costs to an investment manager, or maybe 50 basis points extra in expected return that can be achieved, those are significant impacts on client outcomes. When we're talking about in the realm of withdrawals from portfolios, those are material impacts. And so that's why it's absolutely crucial to get the investment solution itself right, so that we can build as much confidence in that those assets that are invested. One thing we can do to mitigate sequence risk is to actually invest in something that makes a lot of sense, and we're not going to be subject to unwanted surprises in the portfolio itself. Using tools that are available, we do probably have a slight lacking of tools in the UK, but there are plenty of options out there, and an increasing number of options to really improve those conversations with clients, illustrate to clients the things like the presence of sequence risk, the challenges with things like Monte Carlo tools to help illustrate the reality of volatility that exists, and so yeah, investigating what's out there to help improve those client communication conversations is an important point. Having conversations up front, no one likes surprises, clients least of all. So having a conversation up front that, look, if times get tough, which we hope they don't, we might have to have difficult conversations about spending, whatever that might be. And that's part of that cash flow modeling approach process is obviously identifying what those spending goals are in the future. And we might sort of have to identify some of those to say, look, we might not have to change the car every 5 years rather than 2 years if markets aren't so kind, certainly in the early days. And finally, using sensible assumptions and reviewing them on a periodic basis at a cadence that makes sense to you, and building a sensible, defendable starting point for having conversations with clients. At the end of the day, a central case assumption is central case, and if it's an average assumption, by definition, 50% of outcomes are going to be below that, 50% above. So having some understanding and appreciation of that gives that puts that sort of reality there to have a conversation around modeling around that central case as well. So thanks very much for your time. There's sort of my details, LinkedIn and whatnot. Feel free to reach out, and I imagine my details will be circulated after the webinar as well. Really appreciate you giving up portion of your Friday mornings. Hope all's well, and if it is sunny where you are, hope you can enjoy the sun as well. So thanks very much.
Ben, that was a great webinar, mate. That was great content, delivered very, very well as well. Just while we still do have an audience of people, if anybody's got any questions that they want to fire over to Ben, please do so. We've got about 5 minutes before we wrap things up. As Ben said, look, if you got to dart off to your next meeting, or you're like Ben and you're chipping off to take a bit of the chunk of the journey, you travelling up to Scotland today, are you?
Stopping in Lancaster. My brother's at university in Lancaster, so I'm going to try and tie it in and see him there if he can.
Nice.
He can find the time out of his studies and or out at the pub.
Very nice, very nice. Thank you all for coming along to Club Live and joining Ben from Albion for today's session. I'll stop the recording. You'll all get a copy of the recording as well if you want to revisit. I know Ben is going to share the slides with you. And again, as I said, if you need a CPD certificate, please do let us know in the feedback form. Everybody have a great weekend.